More investment tools like government bonds and short-term treasury bills can now be issued by the government. Parliament has approved the higher issuing limits up to 2025. Second Finance Minister Lawrence Wong says this will cater to the growth in demand for these instruments over the next 5 years. Here's Brandon Tenoto with more.
$960 billion. That's how much the government can now borrow through the issuance of government securities. The new limit is an increase of $270 billion from the $690 billion earlier. It's also authorized to issue up to $105 billion in treasury bills, up from the previous $60 billion limit.
The increases in the borrowing limits are for specific market development and operational needs purposes and not to cover the government's fiscal shortfall. Any increase in the government borrowings under the GSA and LTBA will correspondingly increase the government's cash and liabilities, but will not increase the government's fiscal budget for spending.
Government securities are issued for specific purposes. For instance, the Special Singapore Government Securities, or SSGS, are non-tradable bonds issued to meet CPF investment needs, while the Singapore Savings Bonds provide a long-term savings option for investors. Treasury bills, on the other hand, have a shorter maturity period. They're offered at a discount but pay no interest. Though there were no objections to the bill, members of Parliament voiced their concerns.
We know that this issuance, the fund raised, are unrelated to the country's fiscal position. So what are the bases and the consideration for lifting the debt issuance ceilings?
One is to request some clarifications over the underlying assumptions behind the amount requested. And second, I would like to query whether this is a good time to actually be borrowing more.
Number one, CPF needs are growing, and I've highlighted. To almost 3/4, 75% of the increase in the proposed limits will be issued for SSGS, for CPF needs. What are the assumptions behind CPF members' needs growing? It's not really about GDP, right? It's linked to resident workforce growth, CPF contribution rates. These are quite predictable and the needs are growing, and therefore we need to cater for it. The second area is to develop the domestic bond market. Even in this period, there is continued strong demand for high quality, safe assets. So financial institutions have demand for these assets. We have reached the limits, and therefore we are also providing for an increase.
A new short-term management tool has also been put in place to allow the government more operational flexibility to raise cash quickly.